Everything has to be paid for. Within 48 hours of a conflict beginning, insurance companies start pulling out. Not gradually, not with negotiation. They exit zone by zone, policy by policy, until entire regions become uninsurable. No shipping coverage, no property coverage, no trade credit, no investment guarantee. The moment a territory becomes uninsurable, it becomes economically isolated, regardless of whether trade routes are physically open, regardless of whether factories still stand, regardless of whether ports still function. This is not a side effect of war. It is a financial mechanism that operates independently of the battlefield, activating automatically when risk exceeds calculable thresholds. This episode examines how the insurance withdrawal creates an invisible economic barrier around conflict zones, why it costs more than most governments realize, and why it persists long after fighting stops. Risk is not a weapon, but it functions like one. How insurance withdrawal works. Insurance markets operate on probability. Underwriters calculate expected losses based on historical data, actuarial models, and risk assessments. War destroys all three simultaneously. Historical patterns become irrelevant when the nature of the threat changes overnight. Actuarial models cannot price what is unpredictable, and risk assessments become meaningless when the scope and duration of conflict are unknown. The result is not higher premiums, it is exit. Lloyd's of London, the world's largest specialty insurance market, formally excludes war-related losses from standard marine, aviation, and property policies. This exclusion has been in place for decades, but it activates in practice only when conflict reaches a threshold that triggers reinsurance withdrawal. Once that threshold is crossed, the entire insurance stack collapses. Primary insurers pull out because reinsurers won't cover them. Without coverage, shipping companies reroute. Without shipping, supply chains break. Without supply chains, factories stop. The World Trade Organization has documented the relationship between insurance availability and trade volume. Countries that lose access to trade credit insurance, a specific product that covers the risk of payment default by foreign buyers, typically see export volumes decline by 15% to 30% within 6 months. This is not because buyers disappear, it is because sellers cannot bear the risk of non-payment without coverage. The shipping cost spiral. Maritime insurance is where the insurance gap becomes most visible and most expensive. Shipping routes through or near conflict zones face immediate premium increases that can range from 200% to 1,000% of baseline rates, depending on proximity to active hostilities. During the Houthi attacks on Red Sea shipping in 2023 and 2024, insurance premiums for vessels transiting the Strait of Bab el-Mandeb increased by approximately 600%, according to data from the International Maritime Bureau and Lloyd's Market Association. Vessels that previously paid $50,000 to $100,000 in insurance premiums for a single transit were paying $300,000 to $600,000. The additional cost was passed directly to cargo owners and ultimately to consumers at the end of the supply chain. They said shipping disruptions in the Red Sea would create temporary price increases that markets would absorb within weeks. They got a sustained rerouting of over 100 container ships per week around the Cape of Good Hope, adding 10 to 14 days to transit time and $1 million to $2 million in additional fuel and insurance costs per voyage. The Suez Canal saw traffic volume decline by approximately 40% in early 2024, according to Egyptian government figures reported by Reuters. The compounding effect extends beyond shipping premiums. When insurance costs rise sharply on a specific route, shipping companies do not simply pay more, they reroute. Rerouting increases fuel consumption, extends delivery timelines, and disrupts inventory management systems that operate on precise scheduling. The ripple effect moves through the global supply chain in ways that insurance premium data alone cannot capture. The investment freeze. Beyond trade, insurance withdrawal triggers a broader investment freeze. Political risk insurance, products that cover the risk of asset seizure, contract repudiation, or currency inconvertibility by governments is a prerequisite for most foreign direct investment in emerging markets. When political risk insurers withdraw from a country or region, foreign investment follows within months. The World Bank's Multilateral Investment Guarantee Agency tracks political risk insurance coverage globally. Countries that lose MIGA coverage or equivalent private sector political risk coverage typically see foreign direct investment inflows decline by 40% to 70% within 1 to 2 years. For conflict-affected countries, this decline is often permanent for the duration of the conflict and several years beyond it. Iraq provides a case study. Following the 2003 invasion, political risk insurance for Iraq was effectively unavailable for 3 years. FDI inflows between 2003 and 2006 remained below $1 billion annually, a fraction of the investment Iraq's oil sector alone could have attracted under stable conditions. The insurance gap did not prevent investment through sheer physical danger. It prevented it through the absence of a financial safety net that institutional investors require before committing capital. They said, once security conditions stabilized, foreign investment would return rapidly to fill the reconstruction gap. They got a 3 to 5 year lag between stabilization and meaningful insurance market re-entry, during which reconstruction proceeded at a fraction of its potential pace. The property and mortgage collapse. Insurance withdrawal does not stop at international trade and investment. It reaches into domestic economies through property insurance and mortgage markets. When property insurers withdraw from a region, either because of active conflict or because of sustained instability, the mortgage market collapses alongside them. Banks require property insurance as a condition of mortgage lending. No insurance means no mortgage. No mortgage means no housing market. No housing market means no wealth accumulation for residents, no collateral for small business loans, and no economic foundation for recovery. In conflict-affected regions of eastern Ukraine prior to 2022, property insurance had already contracted significantly due to years of instability. Coverage rates in Donbas regions fell below 20% of pre-conflict levels, according to data from the National Financial Services Commission of Ukraine. The absence of coverage did not simply leave homes unprotected. It removed the financial infrastructure through which property could function as economic collateral, freezing the local economy in place regardless of whether physical destruction was widespread. The domestic trade credit collapse. Insurance withdrawal does not only affect international commerce, it reaches into the domestic economy through trade credit, the financial product that allows businesses to extend payment terms to buyers without bearing the full default risk themselves. In normal conditions, trade credit insurance underpins approximately 7% to 10% of global trade volume, according to the International Credit Insurance Distributors Federation. When insurers withdraw from a conflict-affected region, domestic suppliers stop extending credit to buyers. Cash on delivery becomes the only option. Small and medium enterprises, which account for 60% to 80% of employment in most developing economies, cannot operate on cash-only terms. Their margins are too thin, their inventory cycles too long, and their cash reserves too shallow. The World Bank documented this pattern in post-conflict Iraq. Between 2003 and 2005, trade credit availability in Iraq fell to near zero. Domestic commerce contracted by an estimated 30% to 40%, not because demand disappeared, but because the financial plumbing that connected suppliers to buyers had been severed. Physical infrastructure was partially functional. The insurance and credit infrastructure was not, and without it, the economy could not move. The recovery delay. Insurance markets do not return to conflict zones quickly. Re-entry requires actuarial data on the new risk environment, data that takes years to accumulate after conflict ends. Reinsurers, who sit at the top of the risk chain, typically require 2 to 3 years of stable post-conflict data before extending coverage. Primary insurers follow 6 to 12 months later. This means that the insurance gap persists as an economic barrier for 3 to 5 years after active hostilities cease. During this entire period, trade volumes, investment flows, and property markets remain suppressed, not because of ongoing physical danger, but because the financial infrastructure required to support economic activity has not yet been rebuilt. They said the end of fighting would mark the beginning of economic recovery. They got a 3 to 5 year insurance re-entry lag that kept trade, investment, and property markets at conflict-era levels long after the last shot was fired. The World Bank's post-conflict recovery framework identifies insurance market restoration as one of the slowest components of economic normalization, typically lagging behind physical infrastructure reconstruction by 2 to 4 years. The long account. The insurance gap is not visible on battlefield maps. It does not appear in casualty reports. It generates no headlines. But it functions as one of the most effective economic isolation mechanisms in modern conflict, activating automatically, operating independently of military action, and persisting long after the fighting ends. A conflict does not need to destroy a port to stop ships from using it. It only needs to make the port uninsurable. A country does not need to seize foreign assets to deter investment. It only needs to make those assets uncoverable. A city does not need to burn down to freeze its housing market. It only needs to become a place where no insurer will write a policy. The total economic cost of insurance withdrawal in a single conflict is difficult to calculate precisely because it operates through absence rather than presence. It is measured in trade that did not happen, investment that did not arrive, mortgages that were never written. But the World Bank's framework for estimating the economic cost of financial isolation in conflict-affected states places the figure at 8% to 15% of GDP annually for countries that lose access to standard insurance markets. For a mid-sized economy with a GDP of $50 billion, that is $4 billion to $7.5 billion per year, silently, automatically, without a single additional missile being fired. This is how war becomes economic, not just through destruction, but through the withdrawal of the financial systems that make economic activity possible in the first place. Subscribe to the price of conflict, because the most expensive weapon in modern warfare is not always the one that fires,